Hello, I'm talking about a way to vastly increase the effect of the housing spend of any government. Um, Most governments in the world, or many, especially in Africa and other places that are developing, wish to greatly increase the number of houses in the country. There's generally talks of housing shortages, etc. Now, what is mostly done is that the government takes money out of its budget and it builds housing. That's what's happened in South Africa, where I stay, where the government says it's built 3 million houses. Most people don't think they're very good houses, but they have in fact built at least some houses. What they've done mostly is to simply give them away to certain people. So some people were very lucky, they got a house. Most people got no house at all. Now, there are around about 50 million houses, 50 million people in South Africa, and so there's still a lot of houses needed. But here is a way for any government to create a huge increase in the amount of housing, which will in fact boost the economy and create a lot of economic growth as well, without having to do this brute force method where you have to spend all the money in order to create housing. Okay, if most banks don't want to lend 100% mortgages to poor people, that is the bottom line. So, however, they will lend smaller percentages where the risk is higher. So a bank will lend, say, 50% or 60% of the amount of the loan. So say the loans, let's talk about $10,000 houses, right? That's near the low end. Could be $20,000, $30,000. Let's talk about $10,000 houses to keep the figures easy. Now, if the government needs to build 1 million $10,000 houses, then that's $10 billion it has to spend, which is a lot of money, especially for a developing country. Now, if the government makes a deal with the banks where it says something like this, first of all, the bank will lend the first 50%. This is known as senior debt, which means that the bank isn't in trouble unless the house ultimately sells for less than 50% of its value. So the bank's in a pretty safe position, and I talk in another lecture about auctions, about how to have an auction system in your country, which when people default on their loans and you have to sell the property, makes sure that you get a good price for it. And also, in another lecture, we talk about how to reduce the number of occasions where that kind of sale has to happen. So, the person themselves, even a poor person, will put down maybe 5% of their income. It's good that everyone has a stake in the system. Maybe 5%, 10%, of the price of the property. So, if you got a $10,000 house, then we're talking about $500, which might be a lot for a poor person, but they can probably raise that through friends and family, saving up, etc. And then you put them in a position where they don't want to default, because that's the first money that's lost if they default. And explain how. And then the government then becomes the lender of the amount in between. Say the person puts down 10% and the bank's willing to lend 60% on these houses. So that's 70%, we've got 30% left. So the government then puts in 30% of that loan. Okay? So instead of having to raise 10 billion, they now only have to raise 3 billion. But it gets better. First of all, you've also got a type of insurers that probably wouldn't be applicable to start with, but you get in the West insurers that insure the last 10%, 15%, 5%, whatever of the bond. So say they were willing to put down 10% after a while. So then the buyers put down 10%, the insurers put down 10%, and the banks put down 60%. So now we've only got 20% left. So again, instead of having to raise 10 billion, it has to raise 2 billion to get the same amount of houses. The next stage is you've got to realise that most of the people who buy these bonds won't default. Or if they default, they'll get out of their default. So the bank the government isn't losing all that money it's putting down. It's just putting it at risk. And because it's putting down 20% of the money, it will get 20% of the bond payments from the person as well. So as long as most people don't default, as long as there's not a financial crisis, it will probably be a profitable thing for the government to do. So every year there's more money coming back in that can then be rented out. So the government doesn't need to spend this money it just needs to loan it, and then the money it's getting in is paying back the loan it got from somewhere else. So there will be some people that will be default, and that will be that there might be some loss, but if there's a loss, not all of them will lose everything, the whole amount. So say a property defaults and it's in a really bad way, and you've got a good system for establishing prices, for selling properties at auction or through estate agents, and the person defaults on, and the property sells for 90% of its value. The government's lost nothing. The person's own 10% equity in the property has disappeared. If you've got insurers, say it even sells for 70% of its value, then the government's lost nothing because the insurers covered that 20%, or say 80% of its value. So the insurers lost its 10%, the person's lost their 10%, but the government's lost nothing. Say it sells for 70%, like my previous example. So the person's lost their 10%, the insurers lost 10%, and the government's lost 10%, but not 20%. So it's only lost half of what it's put down. And that's in a fairly extreme situation. Of course, the bank's very safe. It's 50 or 60%. It has to really sell for a low amount for that to go wrong. And the government, obviously, in these kind of financial crises, has the ability to intervene with help programs and suspending payments for a while, moratoriums, etc., to make sure that if it's just a temporary crisis, that people's houses aren't sold unnecessarily during that crisis. So in actual fact, the government's expenditure, in other words, its loss on these things, might end up only being 1% or something in the end. It might even be profitable. So if it only puts in 1% in terms of the actual loss, then instead of having to raise 10 billion, it only has to raise 100 million. So to create 100 times as many houses for the same amount of investment for the government, you can use this kind of scheme. So this is all just to do with different levels of debt. You've got senior debt, which is what the bank has. You could probably call the government's in-between debt as mezzanine, or in-between debt. And then the insurer's got some kind of interest there. It's not really a debt. But if there's any other, you could also get other debtors coming in that were willing to take more risk for more money, and that would be junior debt. So the bank also receives a lower interest rate, but that for the risk it's taking, because it's only got senior debt, not taking a big risk. But it prefers, usually the banks prefer to get a lower interest rate for doing less risky things. But you could bring in a hedge fund or something, or float bonds on the market or something, where a higher interest rate is offered for taking some of the government section if necessary. So the government eventually, I think it's best in investment banking terms if the government's got quite a strong interest to start with, but as time goes on, the government's interest can become more of a guarantor, like an insurer. That's a possibility. Or just other levels of debt can come in from hedge funds and others, paying a high interest rate, and the government can maybe hedge the currency risk if it's coming in from other countries, or perform that kind of function, or make a policy to keep the exchange rate stable for 5 years, or that kind of deal. So as this goes on, the less risky consumers, so the slightly richer consumers that have got maybe stable jobs working for the government or whatever, that all that debt can be provided by the market, and the government doesn't need to provide any. I think as time goes on, it will work that way. So the government ends up just insuring more of the more risky debt of people with less fixed incomes or poorer people, that kind of debt. So you can see from the discussion above the kind of brute force way of just raising $10 billion, which becomes a risk to the government, and then building housing and giving them to people for free, is a very kind of inefficient way to do things. Rather do it in this manner, and then the government's got plenty of extra cash for doing things like subsidising particularly poor or worthy people in the country, and providing help for people maybe when they fall into hard times. And because that's only a small percentage, that can cost a lot less and yet be a much more efficient programme for the country. So that is how you can provide far more housing in your country, create an economic boom from a much cheaper and more effective way than the methods that most people are using at the moment. Thank you.